James Katulas is our guest. He's a lawyer representing 8,000 MF Global customers in the bankruptcy proceedings, pro bono, mind you, so he tells me. And he has told me that any new U.S. regulations won't be very effective as long as firms can just skirt U.S. regulators by going through the United Kingdom, where they can take on essentially unlimited leverage in the first place. This was what MF Global was doing. This was what AIG was doing back in 2008. This is what Lehman Brothers did through its English subsidiary too. Notice any similarity? All of those firms imploded. Now, bear with me because I have to break down a few things so that you can get the most out of my guest breaking down all of this. First, you need to know that there is reportedly no Regulation T equivalent in the UK, or Reg T as it's known. So Reg T is the Federal Reserve Board regulation that governs customer cash accounts and the amount of credit that brokerage firms and dealers may extend to customers for the purchase of securities. Now, according to Regulation T, you may borrow up to 50% of the purchase price of securities that can be purchased on margin. This is known as the initial margin. But where it really comes into play in this story is with regard to rehypothecation of collateral. First, let me explain what hypothecation is. This is where a borrower pledges collateral to secure a debt. But the borrower retains ownership of the collateral, but it's controlled by the creditor who has the right to take it if the borrower defaults. So let me give you a really simple example because I think it's a little confusing to explain on TV. So say this is the borrower, this is the bank. So the borrower goes to the bank and they borrow money to buy a house. They keep the collateral even though they pledge this house as collateral to the bank. But the bank doesn't keep it, okay? The borrower lives in the house and they keep it. However, if they default on their mortgage, the bank can claim the house. So that's hypothecation. The bank has hypothecated the house as collateral. Now, what if this bank pledges this collateral, this house that the borrower is living in, as collateral to somebody else that they are borrowing from or to cover a trade, that sort of thing? That is rehypothecation. And collateral can be rehypothecated again and again. That's known as churning. So that is rehypothecation. You need to know it. Now let's get back to Reg T. It says in the U.S., a prime broker may rehypothecate assets to the value of 140% of the client's liability to the prime broker. Let me give you an example. And by the way, big thanks to Zero Hedge for this example. So if a customer has deposited $500 in securities and has a debt deficit of $200, there's $300 in net equity. The broker dealer can rehypothecate up to $280, okay, 140% of that $200. In the UK, however, there is no limit, no statutory limit on the amount of money that can be rehypothecated. A broker dealer can rehypothecate all the assets deposited by clients, 100% of that $500 in securities. And this is where the plot thickens. Now let's bring in James Katulas, president and co-founder of Commodity Customer Coalition. And thank you so much for being on the show because I know you're in town for this roundtable and we feel very lucky to get to talk to you about this issue.
Thank you for having me.
Yeah. So let's start. First, thank you for bringing this issue to light because I was tweeting about why is the UK so much tougher on banks than the US. They claw back bonuses, they take away knighthoods, and you said, hey, you know, talk to me when they have some kind of equivalent of Regulation T, of Reg T. So you've been focused on this MF Global case. Break down how this whole issue comes into play with this $200 million margin call with JP Morgan.
So basically, MF Global had transferred a substantial portion of assets into its MF Global UK subsidiary, so we could take advantage of things like the absence of a Reg T. Under Corzine's watch, MF Global UK was using about 30-to-1 leverage on European sovereign debt trades.
Okay, and so then how did that end up in the $200 million margin call of JP Morgan?
Basically, in the fall of last year, there were concerns about Greece defaulting that basically increased the amount of margin that was required to keep these positions on. And Corzine was utterly in love with them. And rather than just reduce the size of his positions, he wanted to keep the trades on in full, which meant putting up collateral from anywhere that he and the firm could grab it.
And they grabbed it from customers.
Allegedly.
Allegedly. Okay. Let's talk about how rehypothecation allows for this. Now, you mentioned MF Global had transferred funds to its UK subsidiary, and from what I understand, it's very desirable for U.S. firms to move money to the UK into subsidiaries in the UK to get around U.S. regulators. This is what MF Global was doing, right?
Right, and every major U.S. financial institution is doing this.
Every major U.S. financial institution is shifting their customer money to the UK to get around regulation?
Yeah.
Well,
let's say just about everyone.
How do we know that?
But, I mean, that's a good question. The people who know of the existence of the system call it the shadow banking system because it's done in the shadows. So the way a normal bank works is with fractional reserve lending, whereas if you have $100, you could essentially lend that $100 out 10 times if your reserve requirement is 10%. Well, with the shadow banking system, it's all done with unregulated derivatives that are generally off balance sheet. And when it's done in the UK, there's no statutory limit on how many times you could lever it up. So now 30 to 40 to 1 is a pretty common practice for global financial institutions. And none of it's regulated. Generally, none of it shows up on balance sheets or SEC filings. It's very hard for investors and regulators to figure out exactly what's going on.
Right, and this is the whole issue that is so much bigger than MF Global. But one thing I noticed, a lot of these firms, it looks like they get around moving customer money to the UK it looks like they basically put it in the fine print. And it looks like MF Global did this. It says, for their people that had accounts, we can use your money for hypothecation, for rehypothecation. So does this make the case for MF Global customers more difficult? And does everybody need to be looking at the fine print of whoever they have an account with to make sure their money's not being moved and rehypothecated over and over again?
Well, quite frankly, it's my belief that even if there are losses stemming from a loss in the value of securities due to rehypothecation, that should not impact customers' rights of recovery, especially in this case for monies that were transferred to JP Morgan. JP Morgan was the custodian of client segregated funds. They were also the primary lender to MF Global, and they were clearing and settling the trades of MF Global's house trading operation. Because of this, they had a lot of insight into the activities going on there, and when they received several $100 million in transfers that looks like it came out of customer money, they asked MF Global for a comfort letter saying, will you please sign this saying that we're not actually receiving customer funds? The reason they did all this is because in 2005, there was a revision to the bankruptcy code that was passed providing for what's called a safe harbor, which means that if you are a counterparty accepting cash for the satisfaction of a margin call, you don't have to do any due diligence to ascertain whether or not that's a proper transfer, whether it's stolen money, whether it's customer money, or anything like that. But the safe harbor does not apply if you actually know what's going on. So our boy Jamie Dimon, who is not a big fan of how much you get paid, apparently, is trying to hide behind this 2005 act. They've got at least $340 million of customer funds. I've seen some reports saying they might have $600 million or more of customer funds here, and they haven't given it back. And in fact, in the Lehman bankruptcy, they took about $7 billion of funds that were due to Barclays, that Barclays had put into or had bought out of the bankruptcy process. Okay.
Unwind this a little bit for me, though, because I understand the issue of rehypothecation and firms moving their money to the UK to skirt these laws and you have all of this leverage, and it creates all this liquidity and that risk. How does this unwind balanced with, I know the way that the bankruptcy was treated with MF Global also plays a role in who gets paid? Dissect that for me, break that up for me. How does this unwind in a typical case?
Well, you have a couple different issues here. So what rehypothecation does is that makes a blow up or a failure of the firm a lot more likely. So say if you're 30 to 1 levered, if you have a move of about 3.3% against you on whatever you're investing at, you're at a margin call. Okay, so you don't have any kind of cushion due to the high amount of leverage being used. MF Global basically levered up their entire firm and a large portion of their customer accounts on one trade. I mean, they went all in on this one trade in a very, something that's been a very volatile trade due to, is there going to be a bailout? Is there going to be bailout default? And that creates a lot of volatility in this European sovereign debt. So now the reason in MF Global the customers are involved in this is because they actually took customer money to satisfy margin calls. So in the futures system, there had not been a shortfall in customer funds in a bankruptcy in about 75 years. There's a concept of account segregation that is sacrosanct. It's never been violated. There's very strict rules governing this. And now MF Global is trying to hide behind a defense of our systems were so bad, it was so chaotic that we didn't intend to use customer money. It was just an accident. And they're trying to use that to stay out of jail.
Yeah, do you buy that?
I don't buy it for 1 second.
Yeah, I don't either. I want to continue this conversation. I want to come back and talk more about how this case will work out and a little bit more about this shadow banking system and rehypothecation issue, because it's a little dense for TV, but it is so super important that I cannot stress it enough, and I want to continue talking about it. So we will have more with James Katulis.